Welcome. We are in December already, so here with the ETF Spotlight. Good to see you again, Jess.
Thank you.
And today we're going to talk about the iShares MSCI USA Minimum Volatility ETF. So I'm going to bring that across, Jess, and have you talk about it while you talk. I'll be pointing it out.
Okay, great. So this is one of the positions that we're currently using for allocating to U.S. equities, specifically large cap value stocks that we expect to perform well in a slow growth environment, in an environment where we may be seeing higher volatility, more market risk, and where we're ultimately looking to deliver positive returns from equities, but also manage the downside risk given global uncertainty. So this is what some people would call a smart beta product or a specialty ETF. One of the things we like about it is that you have the ability by using this product to invest in US ETFs, filtering out the highest volatility parts of the market, selecting companies that have less volatility, better growth in market downturns, and overall a higher quality profile. But at the same time, this ETF is incredibly inexpensive. It has a 15 basis point charge, and so it allows us to be selective in the U.S. exposure we're seeking for clients now without incurring a lot of extra cost. And we're able to buy this both for clients who are U.S. domiciled and for clients who can benefit from the reduced dividend withholding tax by trading on the London Exchange.
And we'll put a hyperlink on the email so people can actually see this. There's 163 shares in this ETF. It had a 30-day yield of 2.32%, which is not too bad considering interest rates out there. Uh,
Definitely. It's part of why, from a portfolio perspective, for many of our portfolios, we have an equity overweight or a value stock bias because in a low rate environment, dividend paying stocks are often a better alternative to some of the traditional fixed income vehicles.
and I'm just looking at the top sectors on the second page, the breakdown there. It's got nearly 18, 19% in healthcare, nearly 18, 19% in financials.
You've fairly diversified sector profile here,
Yeah.
but you definitely see an overweight to more defensive stocks. So historically, this position, for example, if you look compared to the S&P 500, one of your top positions is going to be Apple. You're not going to pick up some of the technology companies. You're not going to buy as much of that here. This will select for companies with longer, more stable attributes.
And just looking at the last year, the price is up. Looking at the right one, 7.17% in year one, in 1 year.
Correct. The one-year return here, this fund has also tracked its benchmark nearly perfectly. It's up about 7%. Compared with the overall S&P, which is actually fairly flat on a one-year basis. So in periods of volatility, this really highlights, and it's why we own this, that we expect relative outperformance from a minimum volatility position in more challenging market conditions.
Okay. Well, let's then get up the next slide, which is looking at uh, the iShares MSCI USA Minimum Volatility ETF itself on Yahoo. So I'm just going to click on year to date,
Mm-hmm.
and we can see from the beginning of the year through to today, this is up 4.08%. And what I want to look at is the big drop that happened in August.
Mm-hmm.
Can you talk to what happened around in August there when we put out
Sure.
some
So
emails?
what you saw in August, and to really talk meaningfully about that August and what kind of trailed into September period, you have to look at global markets. So ultimately, August and then going into September was primarily a China sell-off. So we saw a substantial amount of global market volatility on the back of significant price falls and some market challenges that China had with illiquidity, with shares that actually stopped trading, dramatic one-day, multiple-day falls across Chinese stock exchanges, and that uncertainty on a global basis had a significant knockoff effect. So both you have companies like Coca-Cola and Microsoft and Procter and Gamble that have business in China that are potentially affected, but largely that global fear in a recovery in a market where growth is slow, where you see more correlation, and European and U.S. and other developed market stocks reacted poorly to the China volatility. So, and as frustrating as that is, one of the things that we have to keep in mind on a long-term basis, if you looked at this on kind of a 10-year, 20-year market lifetime basis, what you would see that these are pockets of normal, if you will, market activity, that it is expected that in various points in time, for whatever reason, you'll see periods of correction, you'll see periods of heightened volatility, and August and September represent that.
And I'm just going to talk to you here for like the last year, it is up 4%, and but year to date, it is what do we say, up about 4.5.
It's around 4, yeah.
4.2.
So we've got essentially almost a month left in the year to go. The end of last year was fairly strong, which is where you get the difference between the fact. Most of these fact sheets are as depending on which one you're looking at. They're as of end of September, which is into quarter, or they're as of end of October. Most people don't have their November data out yet. Yahoo, of course, gives us the full snapshot, and what we see that in fact. While August and September were challenging, October was actually a pretty good month.
Yeah.
And particularly for some of these higher quality, minimum volatility, dividend-focused positions. And what that really highlights from an asset allocator's perspective or an investor's perspective is the importance of maintaining a focus on your long-term goals. If you sold after or middle of the periods of volatility we saw that were related to China in August or September, you weren't there for the rally in October. You potentially missed anywhere between sort of 5 and 8% of
Let's
growth.
talk to that on the next slide, because that's what I was getting up while you were talking there, was just to show the readers that this is the S&P 500 I've got up now, and I'm showing them that from year to date, so the YTD to today, it's been pretty flat year. It is only up 0.88%. But if we look at the August, and this is the China sell-off, from the 17th of August, dropping down only a week later to the 25th, there was actually an 11% drop in 7 days. Then the market rallied back up, came back down again, but then within, by November, 3 months later, it is back to where it pretty much was before the fall, and it's kind of been a bit choppy since then. Now, I just want to overlay the one we have and show year to date the USMV against the S&P 500, and what it shows is that around May they were pretty much line on line with each other, but then the S&P 500 started to drop down further and highlighted what we're talking about with this minimum volatility, started to break away, and the USMV ETF actually experienced less drop and less volatility.
Yeah, and it's important that disparity in the two positions that you're showing here over recent months is specifically why we use a factor-based position like the minimum volatility criteria in periods of market uncertainty. It's not about stock picking. These are actually still very highly correlated positions. What we're trying to do is position ourselves as best as possible for our equity allocation, for quality and for defensiveness. In what we could think may continue to be a choppy market with more volatility, and going into what's likely going to be, I think we're cautiously optimistic for next year, if that isn't an oxymoron, but that we do expect that there are more opportunities for volatility. There are challenges in China and Russia and Europe, and that buying a high-quality stock portfolio gives us the best opportunities for return with managing downside risk.
And what we actually put out on the 10th of September was when there was the China sell-off, and the markets are correlated, but we did come out with an email that said correctional crisis, and we called it a correction. So that was a good call, and 3 months later we've seen that come back up. But I'm not too sure when we added this now portfolios, this ETF. When did we put this one in?
We've had this now, I think, for at least 12 months. We've added it in gradually. So,
Yep.
And as many of our if our U.S. clients will see, there's some of the portfolio adjustment in the U.S. positions. We've been sensitive to tax losses and taxable gains. So there are other similar positions that are nearly identical to this that trade under a different ticker. So some of our clients may not actually have USMV, but they'll have a position that's near identical, particularly U.S. clients, because we've been sensitive to minimizing taxable gains as we rebalance. But we've gradually increased the exposure to this portfolio specifically over the last 6 months.
Great. Okay. Was there anything further that you wanted to add there for this ETF?
We haven't touched on what is kind of the big elephant in the room for a lot of investors right now, which is the Fed meeting in the U.S. next week. I'd just note that after we see the direction that the Fed is taking and the potential rate hike, we'll put out we'll have two ETF spotlights for December, and we're going to focus a bit more on the fixed income in light of a rising rate environment and the Fed policy going forward. So that will follow shortly.
Excellent. All right. Well, great. We'll get this out now, and we'll update everyone in the next week or so about the Fed.
Great.
Thanks,
Thank you.
Jess.